In investing, there are two kinds of people: those who manage money and those who manage wealth. The difference is subtle, but it is powerful. At some point in a financial journey, every investor faces a quiet but defining question. Should I manage my money, or should I focus on managing my life? Because the journey often begins the same way for all of us. We start earning, we experience financial freedom for the first time. Money to spend, money to enjoy, money to experience financial freedom, money to splurge, money to say yes to things once we were told no to. And then, gradually, saving begins, investing begins. At first, it's simple. Small decisions, small wins, a growing sense of control. And then life begins. Responsibilities begin, family begins, commitments grow, children come into our lives. And with each new beginning, importance of money increases, but the time required to managing it decreases. Somewhere along the way, time changes. Time that was once available gets redirected towards longer working hours, growing responsibilities, family commitments, and fulfilling our aspirations. And in that shift, investing stops being a discipline. What was once intentional starts becoming occasional. Expectations, however, do not reduce. We start expecting more from our money. Faster growth, better outcomes, and in that pursuit, we start making decisions with pressure rather than perspective. There are wins, there are losses, and within no time, those outcomes begin to attach with our identity and status. Investing, which was once truly important, turns into comparison, conversation, and status quo. And without realizing, we shift from managing money to managing decisions. And then comes phases where markets fall and everything that once felt under control suddenly feels uncertain. And that is where the real question surfaces. Are you truly in control of your money, or life is quietly making those decisions for you? Welcome back to Signal, where noisy markets meet simple, sharp, and sound insights for long-term investors. Even traditionally, investing was never a casual occupation. It needed time, attention, and deeper understanding. If you look back, markets were driven by full-time dedicated participants like brokers, traders, and specialists who would spend their entire day in studying businesses, tracking prices, and making decisions. Meaningful direct investing was never a side hustle or a side hobby. It required consistent focus, discipline, and immersion day after day, cycle after cycle. But as markets evolved, a parallel shift from individual independent investing to structured approaches began to emerge. Mutual funds, portfolio managed services, index funds, ETFs, and advisory-led portfolio strategies. Professional fund management became more accessible, not as a replacement, but as a response to the fact that not everyone has the time, the expertise, the consistency to manage their investments. And once you recognize this, the question isn't about investing. It's about your role in investing. Should you be independently managing end-to-end investment process, or should you be delegating it to someone whose full-time role is to research, analyze, and guide you into making informed investment decisions? At its core, managing investments is not just about buying and selling. It's about dedicated time, discipline, consistency, commitment, discipline. And as discussed earlier, life may not always allow us for that. Some investors choose to remain directly involved. They do their independent research, analysis, and manage their investments, while others choose to delegate this responsibility to a professional who can manage investments for them. Neither of the approach is right or wrong. It simply depends on your time, your intent, your interest, your capacity, and commitment you are able to sustain. Managing investments is not one single approach. It involves how actively decisions are made, how diversified investments are, how frequently portfolios are adjusted, and how disciplined overall structure is. And this is precisely where approaches like active management, passive management, structured portfolio strategies come into the picture. These approaches are tools designed to support the role you choose to play. So let's delve into active and passive fund management. Active management, as the name suggests, involves active decision making. What to buy, when to enter, when to exit. It involves research, judgment, monitoring, and consistent decision making. Active management typically comes at higher cost because it needs added time, attention, and ongoing decision making. So why do investors still choose it? Because when markets are volatile, when markets are range trading or directionless, active management can add value. A skilled active fund manager can adjust allocations, manage risks, and identify opportunities that are not obvious to everyone. For instance, in small and mid-cap investing, where information is less visible and requires stronger research, identifying sector-specific opportunities like IT, banking, pharma, or emerging themes, thematic investing like manufacturing, renewables, defense, market corrections or volatile phases where downside protection is important, tactical allocation decisions like shifting between debt, equity, and cash, identifying undervalued businesses or stressed assets. On the other hand, passive fund management follows different ideology. The core idea is not to predict the market, but simply to participate in it. Passive investment management is structured to mirror the index. So instead of outperforming the market, the goal is to stay aligned with market returns. This approach requires fewer decisions, has lower costs, brings consistency. Hence, passive investing is growing rapidly. In India, passive strategies form nearly 15 to 17% of the mutual fund industry, and this share is steadily increasing. Both approaches have their own place in your financial journey. Active management offers flexibility, potential outperformance, and adaptability, while passive management offers simplicity, cost efficiency, and consistency. Most investors combine both approaches, using passive management for stable, large cap exposure and active management for small cap, large cap, thematic, and sector specific exposure. The right allocation between active and passive investing clearly depends on your age, your stage, your financial goals, risk appetite, and how involved you want to be in decision making. And with decision making, I don't mean executing transactions. I clearly mean making independent, informed decisions. And here is where a SEBI registered investment advisor can make meaningful difference. Because the goal is not just to grow your money, but to build a life where your money works for you. On that note, let's conclude Signal episode 28. But just before I go, let me leave you with this choice. Meaningful investing has never been a part-time activity. It demands time, discipline, and sustained attention. So, will you choose to manage your investments alongside everything else that you do, or structure it with the support of a full-time professional who can give required time and attention your investments truly needs?